ज्यादा होने लगता है। तो ना बहुत मजा आ रहा है, कुछ वो देखा तो यार मैंने नोट बनाया मैं कल जब वैसे आज नहीं बच जाएगा नहीं तो फिर भी ये ना तो नहीं आता तो की बात नहीं बस जाएगा थोड़ा सा इतना डेलिकेट प्लान तेरे से अच्छा बड़ा प्लान लगा लो मैं जिसको पानी दे रहा हूँ बस और कुछ नहीं। इसका नाम रू है। रू RHU ROH।
अबे तूने वोट किया स्पोर्ट्स क्लब के लिए? दे देना करना। चेस 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 जीता अभी हम आगे।
कैमरा ऑफ करना।
Hello. Hi. Am I audible? And visible? Can you folks see me? Yeah. Okay. It can be a little bit, more audio receptive as well. You guys can say yes, always, that's like welcome. So, yeah, I think we are just a couple of minutes. Yeah, we have 1 minute ahead on time. Hi everyone, my name is Aneesh, and I am going to be taking the session today. I have about over 5 years of experience in the financial industry, and I've been in roles across risk management, then strategy, and on credit. So that's sort of my area of interest. From an education perspective, I have completed my CA, and I have done financial risk management as an additional qualification. And I am very passionate about education, and I follow like basketball and the Premier League, the football Premier League, the EPL. Apart from like your IPL and all that. So that's about me. And so I'm based out of Mumbai. So that's where I am right now. So that's the entire thing about me. That's my resume, so to speak. So I would like it'd be wonderful if each one of you can just we can just go around the room and say hi, and like just tell like one sentence about everyone. That'll be a good starting point. Yeah, over to you guys. Or if you people are not comfortable speaking, at least you can just type it on the chat so that there is some kind of buzz. It's not.
Hello, sir.
Hi.
Hi, sir. My name is Vinayak. So I come from a small port town called Vasco da Gama in the state of Goa.
Absolutely. Nice.
Yeah, and currently I'm enrolled in a residential MBA program at Symbiosis Institute of Management Studies, Pune.
Okay, nice, very nice.
Yes, sir.
Yeah, thanks.
So I have done my my graduation background is in BBA finance, and after that I've worked in Amazon India risk management team for 2.5 years.
Wonderful, wonderful. It's fantastic to know that. Thanks for the introduction. Hi, Anushka, 11th grade. Nice to be here. Wow, that's amazing. You started very early and incredible. I mean, I never knew that I'd take up finance or risk management or credit as a career when I was in 11th standard. So kudos to you. Big shout out. Amazing. Hi, Pratyush. Yes, Accenture. Amazing. Great work experience. 4 years. Like now that you're doing a BA, fantastic, like great career journey that is. And yes, please, you can keep your messages coming in. You can just, or feel free to talk. It's not going to be a sermon. So don't think of Sunday as I'm not conducting a church here. This is a workshop. So it should be two-way. And, just please feel free to just have that energy, have that buzz. Yeah.
Hello, sir. This is Saksham. I'm from Shimla, Himachal Pradesh, and currently I'm pursuing my MBA from NMIMS Mumbai.
Oh, that's amazing. NMIMS Mumbai. That's very good. So you are studying on campus or
on campus?
On campus. Okay. That's
yes.
amazing.
Thank you.
Okay, Rayanshu, MBA, BBA from IP University. Great, fantastic. Anjane. Yeah, okay. So you've completed your BCom and now you are in PGDM. That's great. Yeah, Shantanu, you've raised your hand. Please go ahead.
Sir.
Yes.
My name is Kulkarni. I'm from Pune. I'm currently pursuing MBA at IIM Shillong, and I have a formal work experience of 18 months before this.
That's wonderful, wonderful. That's incredibly great. Yeah, thank you for the introduction. Yeah, anyone else that quickly wants to introduce? You know, I see some
Hi, sir.
people. Yeah, go ahead, please. Yes,
Yeah, hi, sir. Amit this side.
I am.
So, yeah, I'm from Kanpur, Uttar Pradesh. Currently doing my MBA. It's like a full-time residential MBA program in IIM Udaipur. I came to know about this course on Unstop. So I was hoping a career in this domain. So I thought to join it and hope to learn better things by having this work.
Absolutely. Yes. Thanks, Amit. We're glad to have you here, and I hope that this workshop is very insightful. Yes, Nile, tell me.
Hi, sir. I am from Ahmedabad. I've done my bachelor's in electrical engineering from PDPU Gandhinagar, and I'm doing MBA from LBSM Delhi.
Superb. Yeah, thanks, Nile, for joining the session. Yeah, superb. So, okay, Ajay, you've done, yeah, it, yes, superb. So, like, great. Yeah, if you want to go ahead, like, is there anyone else? We'll I think we have a fairly good understanding. We have people across, one person is from 11th and the other person has like 5 years experience in risk management itself, and is doing an MBA right now. And we have some guys from IIM, some in NMIMS, people in Delhi University. Like that's great. That's great to be here. As a cohort, I think one of the best things about having a session like this is that there are takeaways for each and every one that are in a different different stage in each of our journeys. And the most interesting thing is that even for me as I speak would be a learning session for me as well. So we are here to share knowledge. It's not going to be it's not, you're not going to hear a lecture. I think you guys do that adequately in your college. So it's not going to be like that. We'll try and make it a little bit a lot towards a discussion or something of that sort. So just if we look at the material, I'm just going to put up something, but don't be guided by this, or don't sort of be take this as okay, this is what this guy is going to cover. No, it's not that. It's like very text light. I don't prefer like heavy slides and all that. So let's turn off my video. Yeah, so this is what is going to be discussed today. And like we are going to see what financial statements are, and what P&L account is, what balance sheet is, and what exactly do you do in terms of when you're doing financial research or when you're doing credit research. Yeah, so like we'll just put some ground rules together. So one is that I would absolutely want everyone to be completely glued to the class, not only because I am taking, but also because then it will be very interesting to see what you and your peers share. And this is going to be a discussion. Like I said, this is not a sermon. The second thing is, if at all anyone is having any difficulty in terms of the text setup, which is my audio and the slides, pause anytime and just make sure that you're heard. You can just drop a chat and I'll just try and address it. The third thing is that with every, these are three sections. Think of it as these three sections. Like we'll just, for the purposes of continuity, I'll just explain that idea. I'll stop and pause for questions. We'll discuss, we'll have all the questions there. Okay. So that is how, we'll introduce the concept first, take up some discussion, and then take up questions. It's going to be the format for today. Okay. So I am going to invest my 1 hour, and you guys are also going to invest your 1 hour, and we are going to make it productive for everyone. Yeah. So with that, I'm going to the first topic of the Yes, and the final request is that if you are not in a place where you can unmute your audio, it's preferable that you mute yourself so that other people can have a very good experience of today's class. Yeah. Okay. With that, I am going to start with what financial statements are. Okay. So what are financial statements? So financial statement for a company, you would have seen, that, okay, there is something related to, there is something related to a financial position. Does it relate to your financial transactions? What is that? You can't, like really sort of report everything, right? It does not make sense to do that. So, for instance, when in accounting, you would have read through the process or know the process of what how financial bookkeeping is done. So you start with a journal entry, then you pass a ledger, and then you make a trial balance, and from trial balance you make something called as final accounts, or those are what you would call your financial statements. So if I were a shareholder of a company or a credit analyst, I will not be interested to know what happens on an everyday basis, because firstly, it does not give me any insight to what I would want to do with that. And secondly, the sheer volume of data will be so overwhelming for me to provide any meaningful analysis. For example, if I'm a shareholder, I will not be wanting to know what is the daily sales or daily, like hourly purchases that a company is making, but rather what would be meaningful for me is to analyze the financial statements or analyze some summary, okay, at specific periods or at frequent intervals. So that is what that's the purpose that the financial statements serve. From a company perspective, financial statements, the definition is given by the Companies Act, and all the companies are required at least a yearly basis, and in some cases at a quarterly basis, to publish their balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and notes to accounts. Okay, so now let's understand and analyze each one of this mumbo jumbo, what exactly the balance sheet is, or what exactly a P&L is. So a balance sheet is a statement of assets and liabilities as on a particular date. What do assets mean? Assets mean positions or standings that will help me collect cash at a future date. It represents some items of value that the company owns that can be monetized at a current or a future date. Okay. What are liabilities? Liabilities are positions that the company owes to some other person at a present day, and that liability is due either today or at a later day. Okay, so assets and liabilities. Asset, for instance, like, okay, so when I described asset, I was particularly mentioning one bird, if you would have noticed, monetized assets, like monetization. Okay, so here, if you I have talked about monetization, monetized assets, monetizable assets, or monetized assets. So what do they mean? Okay, versus non-monetized assets. Okay, so what does that mean for a particular company? See, an asset is something of value, but it also has to be has the ability to be represented in terms of number, a financial number, rupees, lakhs, and all that, and it has to be has to have the capability of being recoverable or realizable. I'll give you an example. So if a company is owning shares of one particular, say, ABC Limited, okay, so shares of ABC Limited are traded in the Bombay Stock Exchange, BSE. So whatever is the ticker number, whatever is the share price assigned against it, I'll be able to sell it at that rate. It's a monetized asset. So, or I have the company has some receivables outstanding from Mr. Lal. Okay, so it can give Mr. Lal the requisite documents and collect whatever the amount that it is being owed. But on the other hand, can a company realize anything on say its employees? Employees are their assets, right? But like, can a company say that, what, I'm having this person as an employee and who is a very, very good employee, so say X Limited, you give me this much money and I'll give you this employee? That does not work, right? So all the monetized assets are the only ones that needs to be represented in the asset side. Similarly, all liabilities, monetary liabilities are represented there. Non-monetary liabilities are, sometimes, for example, contingent liabilities. We don't know that, what is the value of damage that a product could make. For example, I'm making pressure cookers, like they just sometimes, they go bad. Or I'm making a car, okay, a car, for safety reasons, it could be recalled. Or a pharma company, like I'm making some new kind of drug. So there is a liability. Sometimes that could happen, that, if the drug fails, then I'll be required to pay some a penalty or something. Or, I'll be paying some compensation. I don't know how much this liability is. So this will not be in the balance sheet, but it will be part of the contingent liabilities. Hi Ronit, yeah, welcome to the session. Yeah, thank you. So these are your assets and liabilities. So a statement of these is what is in your balance sheet. Okay. So the second concept that we are going to see is second financial statement component is my profit and loss account, or income statement, or income and expenditure. Again, it has so many names, but conceptually it is the same, and it is very straightforward, right? What you earn versus what you spend. What you earn is your revenue. What you spend is your expense. What you earn is your income. What you spend is your expenditure. Yeah. So there are so many items of revenue that a company would be accruing over a period of a year, and all these incomes have to be tabulated. Okay, so I can't say that, I received 100 rupees selling say product, a pen, to this person. I like, for example, I know that everyone of you would have heard of Amazon, for instance, or a seller that's in Amazon. If he's saying that, I have 15 products, I'll give like revenue saying, 100 units of this I sold to Aneesh, 100 units I sold to Mr. Dev. All these things, that's it does not sort of make, again, meaningful sense. So these kind of transactions are combined into one account, right? Sales account. And they are being categorized in a very different lens. So you have something called operating revenue, and you have non-operating revenue. Operating revenue is what you do as your bread and butter, and non-operating revenue is anything other than your operating revenue. So operating revenue, then you have operating profit that's tagged to it, then you have non-operating revenue, then non-operating expenses. Finally, you arrive at the profit or a loss for the year. Yeah. Thirdly, we have cash flow statement. This is very important. One of the things that at least at a school level, again, Anushka, you would be having your when you're preparing these notes and all, you'll have balance sheet and P&L, but not a lot of exposure will be given for cash flow statement. But it is a very important financial statement because it tracks the flow of money. It tracks the flow of cash, because cash is the king. Okay, there is no two ways, or there is no counter argument for the statement that I just made. Cash is the king, because if you have a liquidity, or in terms of financial research or commentary, people write the term gunpowder, right? Gunpowder is not your army military loading kind of thing that you use in cannons or rockets, but when in financial markets, when people write about gunpowder, it is liquid cash. So liquid cash is like gunpowder. It can you can acquire an organization, you can acquire shares, you can invest in a business. So cash is like a very, very versatile asset, right? So cash flow is very, very important from that perspective, and it helps an analyst and a shareholder understand the current and the future, cash positions that the company will be having, and it also empowers management, say CFO and everyone, to take empowered decisions to support the cash flow. Yeah. Fourth, we have statement of changes in equity. Yeah. So again, this is something that is a little bit foreign to what your regular bread and butter accounting books will talk about. Statement of change in equity is a disclosure requirement for large companies that are having over a threshold of some turnover and all that. Basically, it is applicable for big companies. So why is it relevant is because a shareholder or an analyst should know how the shareholding pattern has changed, for, from for a particular period, and also, sorry, not just shareholding pattern, but also in terms of the capital position, like if there are any sort of equity enhancements that are going to be made, or if there is a capital issuance that is going to be made, or how that has sort of affected, these things an analyst should be required to understand. But again, the very essence is that it's a statement predominantly covering the ownership, or covering ownership interest. So that will be what this particular statement will cover. Yeah. So that is another component of financial statements. Then finally, we have probably what is the most useful in doing research. Okay, probably the most important from a research perspective is your explanatory notes. Yeah. So why is that important? Because that sort of tabulates everything for you. If you see a balance sheet, and if I see a balance sheet, there is a like, it is nothing beyond numbers, right? It is nothing beyond numbers. We can't say whether whether it is good or bad, or just on the face of the balance sheet. I can't tell you whether of course you can tell, but it does not give a very good understanding of decision making. Okay, whether I can tell you that whether the company is not completely indebted, whether it is not going to fail, or it has not started, all those things I can tell you, right? Just from seeing the balance sheet, I can see the reserves and surplus. If the reserves and surplus is positive, then I can tell you that the company is profitable, right? And if the company has a lot of cash and cash equivalents, investments, bank balance, and all that, I can tell you that the company is cash rich. But beyond that, I will not be able to tell you meaningfully what exactly has happened, right? So, however, the notes to the financial statements will help you gain that understanding, right? What is the understanding? It is that it will contextualize what happened in the year and say that, this is the position, this is the breakup, and I've put something as non-current assets, non-current liabilities, or like current assets, but this is the breakup. Yeah. And so that is one part. And there are some text, like free text also, say, like we'll be able to know that the company has raised something on raised a new bank loan facility, something like that, through perusing the notes, explanatory notes attached to the financial statements. So these are the documents that you have to really understand and analyze the situation. So yeah, these are financial statements. So now I'll open up the floor to discussion. So we can all unmute and sort of ask any questions that you'd be having. Are we clear till now? At least if you don't have any questions, please type that you are okay with, or if there are any questions, please feel free to unmute and ask. Yeah. So I'll stop here for discussion. Yeah, Akshat. Thank you, Akshat. You have if you had a good understanding of this. Yes, people, please feel free to. Yes, yes, yes. Please keep them coming. Can you please tell what change in statement change in equity? Yes. Okay. So I'll just take questions at one go. People, you can feel free to ask the questions as well. I mean, it's not that you should type them. I mean, it will be very interesting because and I would actually suggest that if you can unmute and speak, because what will happen is that if you have any follow-up questions, you can ask them when I'm explaining it again or when I'm clarifying something. So far there has been one question: statement of changes in equity, what is that? So a statement of changes in equity is a very simple statement on how my capital account and my revenue reserve, reserves and surplus has moved during the year. Yeah. So just like how my cash flow is a position, cash flow statement is a movement of my cash balances, opening balance to closing balance, and how it has sort of moved around. Similarly, a statement of change in equity is something that's a statement that tells you that my capital account has moved from X to Y. So I started the year with 1,000 rupees as capital. I had given, or I had raised new capital through preference share, through equity share, through rights issue, through, or if I had a bonus issue, which does not impact my shareholding capital, but like just my number of shares or anything, if something has changed, anything has changed, it will be available in the statement of equity. Similarly, there were any buyback, okay, buyback or any sort of redemption of capital, or by virtue of a contract or something has been sold off and nullified. So all those things form part of your statement of change in equity. So again, you have people disclose the retained earnings balance as well. So that will be your retained earnings, your reserves and surplus. So it'll be reserves and surplus, my opening balance, whatever is the earning that I received during the year, which is my profit or loss, plus or minus. And then if I've given out any dividend, if I've utilized that reserve for something, then what has basically changed. So a cash flow, you can think of statement of equity as a cousin to your cash flow statement. Cash flow, may you have cash and cash equivalents. In statement of change in equity, you have capital balances. Is that clear? Rayanshu? If there is a follow-up question, yes, you can always, prefer to unmute and ask. So it also, I should also have the feeling of teaching to other human beings, and I'm not talking to bots, right? So you can all absolutely feel free to unmute, discuss what exactly. In fact, I'd suggest that you can all unmute, because we're going to have a discussion on financial statements and how I would like to ask a few questions to people that have that are there. Specific questions as well. So see, first thing is that for the people that are that are doing their MBA or that have done their MBA, close to finishing their MBA. So tell me, when you start with financial analysis or financial statement analysis, what is the first thing that you would do of a company? What is the first thing that you would do? So can anyone answer that? Ajay, Ronit, I see you guys. Yeah, Pratyush. Anyone that wants to take a crack of the question? So the question is, what's the first step? If I'm asking you to start analyzing a company, what is the first step that you would want to do? What's the first thing you would ask me?
So the sector of in which the company is operating in.
Okay, yeah, you can ask the sector of the company that is operating, that the company is operating in. Yes, thanks, Vinay. Anyone else? Come, please keep it coming. Please chip in. I think between us we can analyze the company. Huh?
Sir, profit of the company.
Yeah, profit of the company, Ajay. Yeah, that's a good input. You can start with that. Yes. Guys, feel free to speak. Huh? Business model, Nilisha. Yeah. Yeah. That see a clear understanding of a business model is absolutely needed to understand or analyze one particular company. Yes, Nile, that's a great input. Keep them coming. Yeah, financial statement. And yeah, that's a great thing. Yes, financial statements will start with that, obviously, because if you read the financial statements or if you read the annual report, you'll have all the answers to these questions. Yes. Ryanshu, yes, the past statements. Yes. Anjali, you're right. We need to identify the risks. Yes. Can anyone unmute and speak as well? Like, I mean, do you not think that typing is it's a hassle that we can actually verbalize and speak, hear each other's voice, and future growth, Prachi Gupta, yes, definitely that's an aspect that you would want to see or understand or ask a question on. Yes. Anyone, come on, just I'll give you 10 more seconds. Put as many answers as possible. 10 seconds. 9. Goodwill of the company, Ranchu. Yes, that's a good input. Comparing current.
Maybe the competitors.
Yes, competitors. Yes. Financial ratios, Vinayak. Yes, great. Yeah. Superb. So, yeah, these are very valuable inputs. As you said, the fundamental would be to start with the financial statements to get everything, and you have your business model, you have competitors, the markets that they serve, current performance with past performance, goodwill, future growth, identifying the risk. These are absolutely brilliant inputs, guys. I mean, I'm seriously telling you, and all these are given in one document. Okay, the company provides everything in one document, which is called the annual report. Okay, so all the information related to the company will be available in the annual report of the company. Okay, so here's another thing. Okay, some companies or most of the listed companies, what they do is that they publish their quarterly financial statements, right? Along with the quarterly financial statements, they also publish something called analyst presentation. Okay, just let me just type it for you. Analyst presentation. Okay, so analyst presentation or an analyst deck is something that the company presents to analysts to draw attention to some aspects of performance. So as a next step, okay, I would implore you guys to read one annual report, at least download and see the index. If not reading the entire thing, at least download one annual report, download one analyst presentation, and read through what exactly is there. Okay, you need not read the entire content. Just spend 10 minutes familiarizing or acquainting yourself with what is there in that document. Yeah. Okay. Now we'll move on to the next one, which is your profit and loss account. See, we had a very valuable discussion on what a profit and loss account is. So we'll again not go into the intricacies or deep dive. So with the understanding that we had when we were discussing financial statements, profit and loss account tabulates my total revenue and total expenditure. How does it do that? You have operating revenue, you have non-operating revenue, you have operating expenses, you have non-operating expenses, and finally you have profit. Okay. Profit, you can think of arriving in various stages. And again, it's a very colloquial term, stages, but just with your understanding, you can think that it's like an Amazon delivery. Okay. So the entire thing is your package. Okay. And then you remove the box, the cardboard box. Then you see the wrapped package. Then you take off that, that's whatever that plastic wrapping bubble paper is. You unwrap that, and then you have the product, and the product will have another dabba, right? And take off that dabba. That's where you will get your phone or your your headphone or whatever. Yeah. In the same way, like everything is a package, right? Everything is a package or a product at each and every stage. Just it has different names. This is whatever that is added. So a profit and loss account is like that, in that the profit is arrived at different stages. So you have something called profit before tax, profit before, like, and you have EBITDA, okay, which is your, or PB, like earnings and profit are the same. Guys, don't get there's no difference or distinction that that is needed. Okay, so people compute earnings before interest, tax, depreciation, and amortization, which is called EBITDA, and reducing. So, okay, you have something called net earnings, and then you have net earnings plus some factors, net earnings minus some factors, to really sort of slice and dice. Okay, like analyzing numbers in a very, in so many ways. Okay, that's what they are trying to do. So there are 4 terms that you should absolutely be aware of. One is profit before tax. Profit before tax is all your revenues minus all your expenses except tax. Yeah, first. Second, you have profit after tax. Let me just write it down for you. First is PBT. Okay. Excuse me, my mouse pad is not up to the scratch, but this is PBT. Okay. Then you have PAT, profit after tax, and then you have EBITDA. Okay, EBITDA, and then you have EBIT. Okay, these are the 4 terms that you would definitely want to understand. Profit before tax is all expenses, all income minus all expenses excluding tax. Profit after tax is the complete profit that is available to distribution to all the shareholders, or like as applicable, like whatever distributable profit that you have. EBITDA and EBIT are purely mathematical numbers. There is no stage. Okay, there is no stage where you have in your profit and loss account that they will tell you that this number is the EBITDA, you please pick it. However, there is a way to calculate it, which is earnings before interest, tax, depreciation, and amortization. So when you know your PAT, okay, when you know your PAT and you want to come to EBITDA, what will you do? You will add interest, you'll have tax, you will add depreciation, then you'll add amortization. Is that clear? Similarly, when you want to come from PAT to EBIT, okay, then you just add interest and tax. So now, if you don't want to start from PAT, okay, you want to start from PBT. Okay, PBT moving to EBITDA, what do? You add interest. Yes. Would you add tax? No, because PBT is already exclusive of tax. Then you add depreciation and amortization. Is that clear? Then finally, from PBT to EBIT, you'll just add interest. Is everyone clear with this? I'll tell you why these 4 are used. However, for now, the understanding is that these are the 4 metrics that you would use as an analyst. Okay. So now why? Okay. So why do I have interest? Okay. Why do I not just start with PAT itself? Okay. Why do I have to analyze anything other than PAT? Because after all, that's the end of the day. That is the money that is available, right? That is the hard cash. Cash is the king. Okay. That's the first accounting rule. Cash is the king. Okay. So I have cash. This is the PAT is my cash that is available. Then why not will we just start analyzing from PAT? Okay, the point is that PAT has 100 factors that you need to sort of come at, that you need to consider, which will not necessarily be either adding value to equity in terms of earning potential. Okay, someone said future financial statement. That's a great answer, and that's the reason. Because it will not give you a sense of the future, and second, it does not even give you the sense of cash position. Okay, so I'll tell you why. Okay, for example, is depreciation and amortization. Is depreciation something a cash outflow? It's not a cash outflow, right? It's an accounting adjustment to account for capital charges, capital transactions in an apportioned manner. Okay, so if I buy a laptop, okay, and a laptop costs 50,000 today, and if that laptop can work for 4 years, okay, what I would do is instead of writing off 50,000 in the first year itself as expense, I will tell that this laptop can work for 4 years. So I will provide for 12,500 per year, right? So in the year one, the capital outflow would have been 50,000, but my profit and loss account will have only an expense of 12,500, right? The 37,500, which is the difference between 50,000 and 12,500, will be reflecting in the cash flow statement. Okay, and this 12,500 is not a cash outflow. Okay, so what I would do is that I would add, saying that this 12,000 is just a cash outflow. It's not a cash outflow. So I will add it to profit because I will have cash. I would have not spent on the laptop from my profit. I would have spent it from some other money. Okay, so that amount is still available with me as cash. Okay, so I added back. Then tax. Okay, why are we adding back tax? Because when I'm comparing two companies, okay, one company is having a different tax rate. Okay, one company is having 25% tax. One company is having 30% tax. Another company is not having any tax because it's a special exempt company. Okay, can I compare all the three PATs? Can I compare the three companies' profit after tax? No, because they have different rates of taxes. When I'm comparing an Indian company with an American company, can I compare PAT? No, because the tax in America is different, tax in India is different, right? So PAT does not allow that comparison, the cross comparison. Sectoral, someone was saying sectoral, right? So sectoral comparison also does not allow because different sectors are taxed in a very different manner, right? So that's why I add back tax. What about interest? Okay, then you might be wondering, okay, sir, fine, tax I'll give you, depreciation I'll give you, amortization I'll give you. Okay, but why do you have to add back interest? Interest is something that I've spent out of pocket, right? I would have given someone interest, I would have given bank interest, I would have given debenture holders interest. Why is that you're adding it back right now? Yeah. So see, firstly, interest is a leverage. Okay, as in debt is a leverage because you don't have capital. It's called leveraging. So you take in debt and you pay interest, and that's a financing cost. Okay, so if you don't take debt, then you need not pay that interest. Okay, if I'm financing it from my own source, okay, if a company is having no debt, then the company will not be required to pay that interest, right? Versus the company that is taking a loan will have to pay that interest. Tell me, if there are two companies, one is taking an interest and is earning 50,000, another company is not taking any interest and is earning 60,000, but this company is paying 25,000 interest. Before interest, the revenue of that company will be 75,000, right? Which is more than 60,000, right? So the company that is earning 75,000 is better than the company that is earning 60,000. But if you are not excluding interest there, then what will happen is that you would come to the wrong conclusion that the company that is earning 60,000 is better, right? So again, it does not stop there. Like EBITDA or the rationale of excluding interest right now while calculating EBITDA, this is the understanding, the basic understanding that you're getting. There are several factors such as ratings of a company, the market that it is trying to tap, the nature of funds that it is raising, all that, and you have something called weighted average cost of capital. So these are some advanced concepts that you can build on to get a clearer understanding of what this interest is and how we can compare how one company can be pegged against the other in terms of interest cost. So as an analyst, you would be wanting to understand what EBITDA is. Yeah. So yeah, that is it should read one of the in is a key component in one of the, it stops there. It should be it's a key component in one of the financial matrices, okay, which we'll see later. Yeah. All right, so we'll stop here again, and it's time to see whether there are any questions. Guys, please type in your questions, ask your questions. Asking would be better. And
So in your slide, I see a term discounting operations. Can you just explain like what is
okay.
that?
Discontinuing operations are operations that are terminated. Okay. For example, I have two businesses. One business is say a telecom company, and the other business is say cement company. I'm not making any interference. This could be an inside joke for a few people. If I'm thinking that my telecom company is gone, okay, I'm selling it. Okay, so if I can't, it is not like selling a share, right? Okay, share I can just create a trade request and sell it. But selling a company will be like a huge thing, right? I should find the right buyer. I should find, and it takes several years and years. Okay, so what? Till then, I will not want the company to be like, okay, I'm shutting everything down or something like that. Till then, I would be like having some sort of a basic, operation. I'll be selling some assets, like having some sort of income coming in from there. Basically, I'm not going to operate. I'm not going to be in that business line anymore. And I've decided to sell already. And I've told everyone that I'll sell already. From that point of me telling that I'll be selling this to the point of completing the sale, okay, it is called a discontinued operation. Any profit and loss of a discontinued operation cannot come under operating profit or operating revenue, because operating revenue and operating profit are applicable only for businesses that are in operation today and that will be operation in the future also, going concern. Yeah, operating profit is only for going concerns. If you are shutting down a business, it's not a going concern anymore. So you put the profit or loss separately as a discontinuing operation. Is that clear?
So just a follow-up question. So
Yes.
your explanation about this can be related to future retail, which is like currently facing bankruptcy, and they are shutting down operations. So will it be applicable for listed companies as well, the same concept?
Yes, it is applicable for listed companies. It is applicable for every company, because you have accounting standards to that effect. That if there is a discontinuing operation, then you should show it separately. Yes, when you're talking about future retail, if future retail is owned by XX people, right? So the people that are combining that at that level, if they're consolidating their accounts, they cannot show future retail as an operating revenue. They cannot show it as an operating profit. Okay, they should show it as a discontinuing operation. Okay, if they are going to sell that asset to Amazon or to Reliance or whoever it is, till the time the sale is approved, you will be showing, it will be still in the balance sheet. You will still be having those assets in the balance sheet, but any profit of that, okay, will be coming under discontinuing operations. Yeah.
All right. Yeah, got it, sir. Thank you.
Yeah. Okay. Okay. Any other questions? So even like to your question again, if I'm having it need not be a business itself. Okay, for example, if I'm having an SBU, okay, for instance, I am into the business of creating like news and all that, news business. So I have like online, then I have newspaper, published newspaper, then I have magazines. If I want to fold my magazine division, then from the date I've decided to sell that till the date I've actually sold it, it will come under a discontinuing operation. It need not be some other business. It could be a business unit in your own business itself, right? So that's what is the understanding. Yeah. Anyone else? Any other questions? Or if you've understood, at least please tell that you've understood these things. Otherwise, we are taking some precious time out of Sunday and doing all this. So yeah, please, thank you. Thanks, Anjani. Yeah, thanks, Anushka. I'm glad that you understood. And yeah, Ajay, thank you. Yeah, Nili, thanks. Yeah, Saksham. Yes, Sachin, superb. Purnima, yes, thank you. Ayushi, yes. Do anyone have questions? Yes, yes. All clear, so yeah, superb. Okay. Now, yeah, now balance sheet. Uh, so balance sheet again, we told that it is a statement of assets and liabilities. You know, it's a very, very simple thing. Okay. What is that? You have some assets, you have some liabilities. Can we simply put everything in one place? Say that, you know, like these are all the list of my assets, these are all the list of my liabilities. No. Okay. Why should I not do that? Okay. That is like going to a supermarket and asking the person, saying which counter has the food. You know, what will that person answer? You know, everything is the food, right? So similarly, in a balance sheet, it is your statement of assets on a particular day, a statement of assets and liability on a particular date. You can't have general asset. You know, you can't say that, you know, my asset is 10 crore, 100 crore, but you need to break that up into clear segments. So what all the companies are supposed to do is to follow Schedule 3 in preparing their financial statements. And Schedule 3 prescribes a format for balance sheet, which goes like this. You have liabilities and assets. Under liabilities, you have non-current liability, and then you have current liability, and then you have non-current assets and current assets. Okay. For example, what is current non-current? If anything is any asset is recoverable within a period of 1 year, it is called a current asset. If any asset is being recoverable within a period of 1 year, it is called a current asset. If it is more than a year, it is non-current. Similarly, if a liability is due for payment within 1 year, then it is called current. If it is not, then it is called non-current. Your understanding very clear? So that is the basis. 1 year is the basis because financial statements are prepared on a yearly basis. So supposing, sir, if there is something that's coming up in 2024, okay, in 2022, it will be a non-current item. In 2023, it will be a current item. So classification is important. An asset can move from one place to another, can become a current asset after becoming a non-current asset, and vice versa also. Because, for example, investment, okay, you've invested in, say, some 10,000 shares of ABC Corporation. So ABC Corporation, you are seeing that, you know, there is a momentum, there is a chance that you can trade and make profit. But for some reason, you know, ABC makes a very big announcement, and now you feel that the value, okay, of holding the ABC Limited shares will be very high in the future. So what you are doing is you are saying that I will not be selling this. I will not be selling this. I want to keep it for in a more permanent manner. Then it will move from current asset to a non-current asset. Similarly, gold. Okay. For example, if you're using, say, gold, if you're in gold business, and if you're saying that, you know, there is one particular piece of gold that you don't want to sell it right now because you think that 5 years down the line it will be more valuable, then you will move it to non-current item. Yeah. So analysis of current and non-current items are absolutely important, because the way that I would explain it is that all the current items, current liabilities and current assets indicate your liquidity. Okay, indicate your liquidity, and all the non-current items, your non-current asset and non-current liability, denote your financial strength. Okay, so liquidity is one thing. Liquidity is, you can think of being, you know, like say, for example, to give a cricket analogy. Okay, liquidity is form. Okay, if one person is hitting hundreds in every game, he is in form, right? If one person has fundamentally very solid solid position, or has, say, has a career average of, say, 50 and all, then that is the core, right? That indicates the player's strength, right? So similarly, a company's strength is indicated by the current, like non-current positioning, non-current liabilities, and non-current assets. Its liquidity position is denoted by the current and current assets and current liabilities. Okay. So just as how we saw that in the previous discussion in profit and loss account, that net operating income or EBITDA is a very vital factor in analyzing. Similarly, debt equity ratio is something that is very key in understanding the balance sheet. So debt equity is total debt by total equity, which is basically your total debt to outsiders, your debenture holders, bond holders, banks given long-term commitment, secured loans, secured mortgages, divided by your capital, which is your equity preference, freehold capital, which is your reserves, all that. Okay, so that's what you do in analyzing your balance sheet. If this number is limited, okay, so for example, similarly, quick ratio, right? Quick ratio or current ratio is current asset by current liability. If it is less than 1, then you know that in this year I'm going to pay so much, but I don't have that. This year my current liabilities are 10 lakhs, but I have only 8 lakhs. Then it means that I need 2 lakh liquidity to overcome the next 1 year. Okay, so that is a bad liquidity position. And if it is more than 1, then it is a good liquidity position. More than 2, then it is strong. Yeah. So, or 1.5 more than strong. Like it depends on the framework that you're working with. And similarly, debt equity ratio of 1 means that you are your outsider liability and insider holding is the same. If it is better than that, which means that it is 0.5, then debt is lower than equity, then the measure will be less than 1. That indicates the relative strength. If the company is zero debt, then the debt equity ratio will be 0, right? So I'll stop here. We'll pause for discussion. Yes, I would. Any thoughts? Any thoughts on financial statements? Any thought on balance sheet? Now we've completed both P&L and balance sheet. So if there is anything that you would want to ask, please. Just say at least that you understood or not understood, not clear. Yeah, thank you. What is cash flow? Yeah. Okay, we'll address that question. Pratyush. Yes. Yes, Simran. Yeah. So what is cash flow? Cash flow means what is the flow of money, okay? Flow of money in terms of current holdings. So cash and cash equivalents, which is my cash in hand, cash at bank, and liquid investments, how they have moved from the beginning of the year till the end of the year. So there are 3 types of cash flows. One is called operating cash flow. The other is called financing cash flow. The other is called investing cash flow. So operating, I'm just typing it out for you, Pratyush. Operating, financial, and investing. Okay. So financing, sorry, it's financial, read financing. So operating cash flow is basically the cash flow that you have made, okay, from your business. Financing is the cash flow that you've made through raising of capital or repaying capital. Investing is the cash flow that you've made through investing in the long-term asset or repaying the long-term liability of or monetizing your asset, right? So those are investing activities. So a combination of these will be like the complete, this will complete the entire pie chart of cash flow during the year. So if I start with say 1,000 rupees, or leave aside our financial context and all. Okay, if someone gives you 1,000 rupees, okay, say that you go and spend, okay, you'll go and spend on things that are say consuming. You've consumed something, okay, you've gone and had say something in the restaurant, 200 rupees. Some movie you've watched, another 100 rupees, 300 rupees. That is operating activity because that relates to your like regular regular items. financial. So financing activity. Okay, you've repaid some 50 rupees that you took from someone, okay, back, some cousin that you took, and you have lent 100 rupees to your friend. Okay, these are financing. Investing activities. Investing activities are you've bought some equipment, you've bought some headphones, for your school or your college, whatever. So those are investing activities. Again, headphones will not be investing activities. I'm just giving an example. Say buying plant and machinery, buying a new strategic business unit, creating a business, investing in a new business, investing in a new plant somewhere, like within India, outside India, whatever it is. Those are investing activities. So all that, if you're collective, you were given 100,000 rupees. You have spent, say, like various cash flows have accumulated to about 800. End of the day, you will have 200 rupees. Okay. If you put this in a statement in the format given, this is your cash flow statement. Is that clear, Pratyush? Yeah, superb. Anjali, yeah, thank you for the question. Short-term asset. Okay. Short-term asset means inventory, right? And if it is inventory, then it is an operating activity. If it is trade receivable, again, it is an operating activity. If it is bill discounting, it's operational. There is, there is a case that all the non-current assets are only included under investing activity, partly because, see, I'll give you the basic distinction. Okay, operating activity means any money that you're spending will give you profit or revenue this year. Okay, investing is long term. Okay, you've invested in something, return will not come right now. So you will say that, dude, I've spent 500 rupees on this, but this 500 rupees ka return will not come this year. It will be over a period of 5 years. When you start a plant, 500 crore plant you're investing in, say, Bokaro or somewhere. Okay, so you can't ask, okay, 500 crore we've invested, give me 501 crore or something like that. You can't do that, right? So that is where, that's where you need to really classify that. So basically, to your question, if it is non-current, like if it is current, then it will not come under investing activity. Current assets are these, your inventory and all that. So those are not part of your investing activity. Yeah, thank you. So the next question that we had, again, people, you can ask these questions. It will be so interactive if you guys ask these questions. It will be just brilliant for me also. I feel like a webcaster. You would have seen these guys in YouTube, right? PewDiePie, or if you've seen, PUBG, like commentators. I feel like a PUBG commentator right now because you guys are not speaking. So, okay, what is being paid in cash in accounting? Yes, it includes paying someone. See, cash again is cash and cash equivalent, Saksham. So cash and cash equivalent means cash in hand, cash at bank, any liquid securities. Okay, that's what these three are. Again, whenever, but definition of cash itself is that it is legal tender that is accepted. So digital cash is also cash. Yeah. So to your question, it will be included even if you're paying someone through online net banking, GPay, TPay, FPay, whatever. Yeah. So Ryanshu, your question is debt concept. Yeah, debt equity greater than or less than 1. Give me 1 second. Yeah, so debt equity greater than 1 or less than 1. So see, imagine this. Company has 100 rupees as its share capital, preferential capital, and your reserves. Okay, 100 rupees. The debt that the company can take. Okay, so debt holders have the ownership of like they have lien, right? So see, this is a very, very interesting concept. So let me just take a couple of more minutes. I know that it is 5 o'clock already. So Puneet, apologies for extending this beyond the scheduled 1 hour. But this concept, Rayanshu, that you're asking for is a very, very interesting one. Okay, so debt equity ratio is the heart of financial stability or financial, strength of the company. Okay, so if the company is having, see, this is how the balance sheet looks like. Right? So I'm dividing it into non-current assets. Then I have non-current liabilities. Then I have current assets and current liabilities. Apologies, again, I'm not I don't have a trackpad or something like that that I can use. I'm so sorry. So see current asset and current liability. So see net asset, right? This sorry, non-current asset is actually your entire, you have your asset like machinery and all that. Your current asset will be your cash balances, stock, inventory, and all that. Your CL, current liabilities, will be your trade balances and all that. And non-current liabilities will be your debt or will be your equity. Okay. So so this is how your balance sheet will be. Now there are two ways to compute equity. Okay. Equity will be your assets minus liabilities, which is your net worth, right? Your net worth is whatever that you own minus whatever that you owe. Okay, you own entirety of your assets. Okay, so I'll put this as total assets, TA. Okay, so this is my total assets, and this is my total liabilities. Okay, so total outsider liability will be my current liability plus debt. Okay, equity is the owner's money, right? So that will not be included in outsider liability. So the net worth of a company is calculated by this formula: total asset minus outsider liability. Is that clear or not till now? So now what happens is that the net worth of the company is basically, another way to say is my equity. Okay, whether the company is worthwhile or not, right? So debt is a specific component of outsider money that you have borrowed for the purpose of financing the company. Okay. Now if my debt equity ratio, okay, so which is D by E, if my debt is more than my equity, then the ratio will be more than 1. Correct or not? If my debt is higher than equity, then this ratio will be higher. Say my debt is 200 and my equity is 100 only, then the ratio will be 2. Okay, which means that the company, for every 1 rupee that equity shareholders are owning, debt guys are having 2 rupees claim to it. Okay, so the net worth is very weak. Okay. Similarly, if it is equal, on the other hand, okay, debt and like these things are equal, debt and equity are equal, then the ratio will be 1. Okay, if equity is more, okay, equity is 200 and debt is 100, then the ratio will be 0.5. Okay, now what does that mean in terms of regular context? It is that when I sell all the assets, right? Supposing if the company is facing bankruptcy, okay, what will happen? I will sell everything. I'll sell all the assets. What is happening with say a company that is in bankruptcy? So all the assets will be sold, all the liabilities will be settled off, and only finally you will be paying your equity shareholders, right? So if like that is what you need to see. If it is more than that and you don't have adequate asset backing, if your assets are volatile and debt equity ratio is weak, then people might see that as a sign of financial weakness. Okay, and generally if already you've borrowed like a lot over your equity, then how will anyone else lend you money? Okay, so if you have 100 rupees in your hand, if you have assets worth 100 rupees, okay, then you can borrow either 100, maximum will be 100 that can borrow, or some amount that's more than 100 if the person is willing to take that risk. Okay, if I'm saying that I want to borrow 1000 rupees and give you say that I have 100 rupees as my net worth, will people lend money to that person? No, because it is credit risky. Okay, credit risk is very high there. So that's the concept here. So in general financial context, what we would say is that if the debt equity ratio is 0 or less than 1, then the company is fundamentally sound in that it does not depend on debt holders for money. If it is 1, then it is equally leveraged or equally geared. There are hundreds of things that people tell, okay, different terms, okay, don't get confused by them, but yeah, equally leveraged. And if the debt is more, then it's a debt heavy company. It does not mean good or bad. It is that if the company is having more debt than equity, then the debt holders will be able to influence the decision of the company. So when you are looking at it from a strategy perspective, then it becomes a challenge that debt holders will not want to take certain risks. Does that make sense? Rayanshu, clear with that? Yeah, okay, super. So yeah, the next and the final one again, this is where I was leading to debt equity ratio. Yeah, DER is debt equity ratio, DSCR is debt service coverage ratio. Whether so these two ratios help in understanding whether the borrower is credit worthy and whether the borrower can pay the money. Okay, there are two things. Okay, when we are doing a credit rating, what we check for is two things. One is whether that person has the ability to pay, and secondly, there is an intention to pay. Okay, supposing if you've given me 100 rupees. Okay, I have my balance sheet is there, and you see from my balance sheet my net worth is zero or negative, then it means that I don't have the ability to pay, right? On the other hand, I have the ability to pay. I'm having my I have a 1 crore deposit or something. Okay, you have lent me 1,000 rupees. I say I will not pay you because I don't want to pay you. Then it is the question of willingness to pay. Okay, so these two are factors, and when a credit rating is assigned, an external credit rating is assigned. Similarly, when the bank is wanting to do a funding decision, okay, DSCR and DER are two ratios that they determine to see whether the borrower is credit worthy. Okay, borrower is credit worthy. How is that borrower credit worthy? If I give the credit, then he has some visibility to pay. Okay, and whether that should not mean that he's significantly dependent on my my funding for running the company itself. Okay, that's being credit worthy. And ability to repay. Ability to repay comes when I'm earning adequate profit to pay EMI. See, everyone would have earned some salary. Okay, I mean, most of you guys know what the concept of EMI is about. Okay, when you go for an EMI, what do they tell you? How much is your salary, or how much is your monthly income? And we will not give you, if your monthly income is say 1 lakh, we'll not give you an EMI of 1 lakh. We'll give you an EMI of 50,000 only, whatever that you can pay for 50,000, 60,000 only. Why is that? Because they know that your other expenses are there and you need to reduce all that, and you will be able to repay only 60,000. That is the ability to repay. EMI and the calculations that bank do for an individual is an extension of DSCR. Okay, DSCR is debt service coverage ratio, and it is calculated as interest by your EBITDA. And if there is adequate debt service coverage, then the banks or debenture holders will be able to lend money to you. And similarly, DER is a debt equity ratio. If there is adequate financial strength in the company, then people will be wanting to lend you at a lower rate itself. If it is not so, then they will want to increase the rate of interest. That's why for a housing loan, you will pay a lower interest compared to a personal loan. Okay, so because there is a fundamental soundness or fundamental credit worthiness that comes in because the house is valuable. But your personal, like you would have seen advertisements. Okay, what do they do for personal loan? Travel. Can they sell your plane ticket to someone else? No, they can't. That is why it is inherently riskier than a housing loan. Housing loan, they can sell your home to someone else, but they can't sell your travel ticket or and what about your motorbike? That also, but there'll be a significant hit in the value, right? So that's why some loans are riskier than the others, and this DER is the concept for that. Okay. So again, what is good? Some people say that this has to be 20%, this has to be like 2 times, this has to be 3 times. That and all is not. There are no formulas for that. This is not a statistic driven exercise, but it's a question of judgment, and how credit analysis is done, and how you need to balance risk and reward. If you are sitting in a bank and if you're extending a loan or something like that, which is a function of a credit officer, right? Or if you're doing credit research, which is you are in an investment bank trying to fund someone for their business, you need to understand the risk and the reward. Okay, so numbers, good ratios are not enough. You should also check your assumption. If I've assumed inherently different things, then I cannot like, if those assumptions are not sort of valid or not in market condition, then I need to rethink my numbers. So that is all about it, guys. Do you understand the concept of DSCR and DER and what a good analyst should do on forecasted numbers? Anjane, yes. Sachin, yes. Superb. Yes, Vinayak. Khushbu, yes. Superb. Anyone with questions? Okay, yes, superb. Guys, you can unmute yourself to ask questions. You can ask anything. We are in the last leg of our session. Ayushi, yes, superb. Is it clear, guys? You can also answer this yes by unmuting yourself, unless until it is very inconvenient for you to do. Aditi, I have not heard anything from you, so maybe you can message or unmute and tell us if you've been able to get the concepts, or if you have any doubts, feel free to ask. Akarshi, anything from yours? Neha, Isha, Durgesh, anything from you guys? Rajyogeshwari, Sagar, anything? Yeah. Okay. So we'll wait for 20 more seconds. People that who've not spoken before, who've not messaged before, please use this opportunity to ask any questions that you might have. Any other any items that you would want to discuss, whatever your thoughts are. You can even unmute and say that, you know, this is wrong, this is what I've done in my MBA or whatever. Anything is acceptable as long as you speak. Deepak, are we clear? Prachi, anything from your end? Purnima, Varsha, Vaibhav? Yes. Thank you. Thanks, Vishal. Yes. Aditi, anything from your end? Rajiv, Kishori, Kashi, people. Yes. Okay, superb. So yeah, you got some responses. Thank you for the responses. So to my next segment. So this is a program that Budding Analyst is launching. So post the workshop, we will be looking to launch a credit research program, and whoever is wanting to understand more on credit research, whoever is looking to master or major in credit and financial, um, so those who are looking to work in financial services industry, or if you are already working, and if you want to feel like you want to get a broader understanding of what it is, you can all register for the budding analyst course. You can note down the coupon code promo50, promo underscore 50. That's the promo code. So what is that? What is that that you gain? So like, yeah, you have hands-on experience on credit research and credit analysis. And yes, you will be equipped with skills on credit research analysis. And then of course you can look at uh, getting into getting into companies that focus on credit research and analysis. Budding analysts have had success there. So there are some testimonials that previous students have shared that the skills that they have learned here have enabled them to get placements, convert their interviews. So that's that's something that will be useful. So yes, so here these are some of the skills that you would understand, get financial spreadsheet, how it works, then analysis of a business model and a management, then like analyzing financials, making financial projections, making recommendations, credit recommendations. So that is it from my end. Thank you for patient listening. I do feel that this has been like a sermon only, so that has not sort of yeah, it has not been different in that sense. But anyway, guys, you can unmute yourself for one, like once, and maybe we can at least I can hear your voice, once, and we can close the session. If there are any inputs, feedback for me, for Puneet, who's organizing on the program, what you found informative, not informative, all that you can please write down, or you can speaking will be better preferred. And please write your names in the chat box for the purpose of the certificate. Please write your names, and in the meanwhile people can also speak and ask questions. So I'll be handing it over to Puneet, who can take take your other questions or anything on the session. Puneet, over to you.
Hi everyone. So if anyone has any questions regarding how to register for the course, and if you have any queries, so we will be emailing you regarding it, and we'll share you the WhatsApp chat support number as well. So you can contact us. You can ask any queries as you might have. And as you know, Aneesh would be taking your training sessions later on, and you'll be getting a lot of content, pre-recorded sessions and live sessions as well, and various other content. And you'll be working on a hands-on project, live project, that will give you an experience on how things work in the actual industry. So these things are going to help you later on. And yeah, so if anyone wants to enroll for credit research program, so you can just contact us. We'll be sharing you an email for that. Moreover, you'll be getting the certificate soon, in the next few days. So all those who have attended the complete workshop will be eligible to, get the certificate. Those who left the workshop in between would not be getting any certificate. So I hope you all have mentioned your names in the chat box, and we'll take a note of it. And yeah, if you have any questions, then just let us know.
Yeah, so I will be here. I'll be like we'll till we finish this call. I'll be around to take questions. Please feel free to ask anything. If you need anything, you can always reach out. Yeah.
Those who do not have any questions and have marked their attendance can leave the session. So it's fine. Thank you so much, Aneesh, for your valuable contribution today. And
Thank you, Knit. I'm sorry that the session went on for longer
right.
than expected.
No problem. It happens. It happens, obviously.
Yeah, I mean,
So we can understand. Right.
yeah.
I guess everyone has marked their attendance, and we'll end the session now. Thank you so much, everyone. Thank you so much, Aneesh. Take care.
Yeah. Thank you, everyone. Bye.